Hi guys, Willie Mandrell at the Mandrell Company, and I wanted to take a little time to speak with you about commercial lending for your buy and holds. We talked briefly, if you've watched prior videos about residential lending and some of the basic mortgage programs. This is commercial lending. This is typically, if you see on the screen, typically 5 units or more. So residential lending is a single family, two family, three, triple decker, or 4 units. Commercial lending tends to be 5 units or more. It can be something that's less than 5 units if it's held in a special purpose entity like an LLC. If you own the property individually, and it's under 5 units, it's typically a residential property. A residential mortgage broker or lender could help you. If it is 5 units or more or held in a special purpose entity like an LLC, then it is commercial lending. Typically what you find with commercial lending, it is performance based. When you're dealing with residential lending, you're dealing with your credit score. You're dealing with your debt-to-income ratio, and you're dealing with still loan-to-value and a couple other factors that affect you personally. When you're dealing with commercial lending, it's more lenders are making the decision based on the performance of the property. So when I say performance of the property, I mean what rents are coming into the property? How much? What is the rent roll for the property? What is the total gross rents that the property collects versus the total expenses or outlay of cash needed to operate the property on a monthly basis, on an annual basis. So typically what commercial lenders like to see is what's called a debt coverage ratio of, let's say, 1.25 or 1.25, which means, I'll give you the simplest example. If you have debt on the property or a mortgage on the property and that mortgage is about $1,000 per month, most lenders like to see at least $1,250 in income coming in, or a 1.25 debt coverage ratio. They also want to see that the property is cash flowing on a regular basis. They want to see that you can sustain the property over a long period of time, and that it is going to be successful for you. So again, it has less to do with your credit score and your personal debts, more to do with the property's performance over time. What else can we talk about commercial lending? Rates tend to be a little bit higher than residential lending. Typically a half a point, I would say, from my experience. You're seeing a half a point, maybe a point more, depending on the risk that the lender assumes with the property. Commercial lending can be recourse and non-recourse as well. Non-recourse loans means that you do not need to give a personal guarantee. If the property for some reason does not perform and the note is not paid, you will not be personally liable for that. So when you're talking about residential mortgages, if you do not pay, you get foreclosed on. That foreclosure goes onto your credit report. There's a ding there when you go to purchase another property. If you are relatively new to the commercial lending space, most lenders probably will want you to give a personal guarantee to the LLC or the entity holding the property. Once you have a little bit more experience, or you hit a certain loan volume, a certain loan number, typically $1 million, you can usually look for non-recourse loans where you are not personally liable for that entity and the performance of that property, said if the property does not perform to expectations. Last but not least, you are typically going to find LTV between 75 and 85%, so loan to value ratios between 75 and 85%, which means, unlike residential lending where you can put as little as 0% down with a VA loan, or 3.5% down with FHA, and 3% down with mass housing, most commercial lenders are going to want to see at least 15 to 25% what they call skin in the game. They want you to have some equity into the property right off the top. That equity can be the equity pulled together by partners. You can have several owners of one LLC pooling funds together to make a purchase that down payment of 15 to 25%. And that's a lot of times what you see, especially with properties of $1 million or $2 or $3 million, where it is unlikely that one individual has the capital, or even if they do, wants to risk the capital themselves. You find that a lot of individuals tend to pool money together with 2, 3, or more partners, form that LLC to meet that down payment requirement. So that's commercial lending in a nutshell. If you would like more information on commercial lending, or would like to be connected with some of our commercial lending contacts, please click the link in the description below and fill out the quick form. Tell us a little bit about yourself, and we can connect you with one of our contacts, one of our lenders that we do business with. Thanks for watching. Hopefully this was helpful.
Thanks for watching our video. Did you find this information useful? If so, please remember to like this video and subscribe to our channel for more helpful videos. I would also encourage you to share this video with your friends and your family. Thanks again for watching, and we'll talk to you soon.